Good morning, everyone, and thank you very much for joining me for the morning market review. My name is Russell Shaw. I'm a senior market specialist at FXCM, and my email address is rshaw@fxcm.com. Today is Thursday, it's the 14th of July, 2022. Let's just bring up our high-risk investment warning. I'll keep this on screen for a few moments. And here's our market commentaries disclaimer, just keeping this on screen for a few moments as well. Okay, and our references, FXCM Market Scope, CNBC, so we'll do the media article in a moment, and then tradingview.com. I want to show you something I'm looking at on TradingView. I haven't drawn a conclusion yet. I'll show you what I'm working on, but I think there's something there. So we'll take a look at that in a moment. It's this chart over here. I'll just keep it on screen. Hey Sam, Anna, nice to have both of you on the webinar as always. Thank you everyone for joining this morning. Really appreciate you logging in. Before we get into the analysis, let's just do our just go through the media article just to understand what what CNBC is looking at. And their headline reads as follows: European markets head for lukewarm open as investors digest US inflation data. European stocks are expected to open slightly higher on Thursday as global markets digest the latest US inflation data. Expected, a big one, European stocks closed lower Wednesday as investors reacted to hotter than expected US inflation data. The consumer price index, a broad measure of everyday goods and services, soared 9.1%, astounding figure in June up from a year ago. That's above the 8.8% Dow Jones estimate. This is really an incredible number. It's effectively the fastest pace for inflation going back all the way to December 1981. Excluding volatile food and energy prices, the so-called core CPI increased by 5.9% compared to the 5.7% that was expected. The reading could prompt the Federal Reserve to hike interest rate by another 75 basis points during this month's meeting. Last month, the Fed raised its benchmark interest rate 0.75 percentage point to a range of 1.5 to 1.75% in its most aggressive hike since 1994. Now, 75 basis points is actually not the base case anymore. So I'm not sure when this was written. The base case is now for a full percentage point. So the market's got a probability of 77.4% of a full percentage point hike compared to only 22.6% for 75 basis points. So this article is not correct there. Okay, we're looking at 100 basis points. On Wall Street, stocks traded lower as investors reacted to the inflation numbers. Overnight, US stock futures were little changed on Thursday morning as traders look ahead to earnings from major US banks, JP Morgan Chase and Morgan Stanley. Okay, we're going to have something to say about that in a moment. Mainland China markets led gains in Asia Pacific on Thursday as Australia's unemployment rate fell and Singapore tightened its monetary policy. There are no major earnings or data releases on Thursday. The European Commission is set to announce new economic forecasts. All right. Let's, yeah, like I said, Anna's saying she remembers the 1980s. And what she's referring to effectively is, the inflation, that rampant inflation, starting from the stagflationary pressures of the 70s that ran into the early part of the 80s, right? Morning, Howard. Nice to have you on the webinar. I want to just show you what we have here. Again, this is a work in progress. I just want to give some thought to this, but I wanted to show you guys so perhaps you can sort of apply your own minds and see if you can see if there's anything here. What we have is the M2 money stock. Okay, so you can see the movement up here. This is, we go into the pandemic, and of course there is just a huge amount of money that gets pumped into the economy, and that's one of the reasons for this really huge rampant inflation, to the point that it looks like was a policy mistake. Now, I think it's bold to call it a policy mistake. The lockdown was a black swan event. How should we have reacted to it? I mean, you've got to make the decision at the time. But what was happening as the money supply was getting increased at such a rapid rate, we also had very, very loose fiscal policy, and the loose monetary policy, the loose fiscal policy, really has what's caused a huge demand side inflation, and that's been exacerbated by the supply shocks caused by the invasion of Ukraine by Russia. So it's almost like a perfect storm here, and this is what we have. I was just in the supermarket yesterday. I needed to get some coffee. I couldn't believe the price. I was like, this is just so much more expensive than just the last time I bought some coffee. You know, so it's really it's hitting us, and it's hitting us on the headline level, not on the core level. You see, the headline level includes food, it includes energy. The core CPI strips those volatile items out, and we've had the question before, well, why does the central banks look at the core number, not the headline number? And the reason for that is because they can't do anything about food. They can't do anything about energy. That's supply side. Monetary policy is all about demand side control. So that's what the core numbers effectively convey to the central banks. What is happening on the demand side? The problem is for us, we get hit on the headline side. You know. All right. So here's this money supply, and the whole idea is, well, okay, we expecting this to come in, okay, because we're going contractionary. What's interesting is we've got a little kick up here. That's astounding. Look at this kick up here. But the actual analysis is on the indicators, is not on the M2 itself. So let's take a look at that. Now, what I want to do is I'm going to change this from weekly. I want to change it to monthly, okay? And then what I'd like you guys to do is actually ignore the money supply and take a look now at the indicators. Now, what we have here, okay, what we have on the indicators, so, and it's asking what the blue line is. So that's key, okay? So this blue line here is our rate of change. And what the rate of change is, it's over a 12-month period. So what it's effectively doing is it's taking value today, dividing it by the value 12 months ago, minus 1 to get a percentage, right? So we're basically looking at the rate of change in the money supply over a 12-month period. And this is where it gets really, really interesting. You can see that the rate of change has come down markedly. In other words, the rate of change spikes up here into the sort of, let's call it the first year of lockdown. That makes complete sense, by the way, okay, because of what we call the low base effect. Okay, there's a huge increase, and what you're doing is you're taking, say, the number on 1st of February 2021, and you're dividing it by the number on 1st of February 2020. Well, the 1st of February 2020 was a very low number. So you're obviously going to get a huge spark up in your rate of change. That's the point. The rate of change of money supply was astounding. You can see the spark up here. Now, if we go back in time, let's just go back as far as we can. There's no spark up like this in money supply. Just take a look at the blue. There's no spark up. So lockdown, and we've gone back here to the 80s, right? Gone back to the 80s. So the point is that the response to the lockdown clearly was a very special response. You know, again, in hindsight, probably too much. But again, I don't think that's fair. I think the policymakers were sort of really under pressure to do something. So that's the blue line. That's the rate of change. Now, the orange line here, that's your core CPI. That's your core CPI. Now, we're not looking at headline CPI. We're looking at core CPI. Why are we not looking at headline CPI? Because monetary policy's got nothing to do with the headline. It's got everything to do with the core, okay? So we're looking now at the rate of change of monetary expansion and what has that done to the core inflation. And we know core inflation is elevated, right? It's elevated. Now, there seems to be, and this is where the analysis sort of has stopped. I've got to try and develop this further. So again, I would encourage you guys, if you have any thoughts, definitely let me know and we'll discuss it. But where there seems to be some sort of really interest is, I'm trying to get a trend line here, bear with me a moment. There we go. Okay, let's just get this, let's call it, let's make it red. Okay, but what we're looking for here is we're looking at basically what's the lag period? So what's the lag period between the expansion in the rate of change of monetary expansion? I think I said that right. What's the lag? What's the lag between the expansion in the money supply and the kick up in inflation? Okay, so that's the question. And it seems that there's about a year's lag. So we go through to the 1st of May. That's kind of when we didn't peak, but you know, this is kind of like a rocket ship, and then the slope perhaps slows down slightly. But so we've got a so it goes through to the 1st of May. 1st of May, let's call it 2020, and just under a year, say the 1st of Feb, 1st of March, is when the core inflation kicks up. Now, again, it's a work in progress, but the point is that the rate of change has come down. The rate of change has come down, and I wonder if that lag brings core CPI down with it. You understand the reasoning? So again, it's something that I'm just working on, but the rate of change here seems to have some sort of relationship. I would suggest it has some sort of relationship with how core inflation responded. Now that the rate of change of money supply has come down, is that going to be reflected in the core numbers? So we want to keep an eye on that. And I suspect that it would, by the way. I suspect that it would, because monetary policy does control demand-side inflation. It does. It's just we're not seeing it. We've got an inflation print on the headline basis of 9.1. We've got an inflation print, CPI print on the core of 5.9. I'm not sure where it's getting at 6.8 here, but anyway, it came through yesterday at 5.9. But So I think that the contractionary policy here is going to work on a core basis. I think it is going to work, and I think there's a lag, and I think that the peaks and troughs here on your rate of change is probably something to try and measure. We're never going to be exact about it, okay? Because first of all, number one, we've got too little data here. There's never been a spike in monetary policy like this, but the point is there has to be some sort of cause effect there, and I think that the rate of change coming down here possibly means that there's a lag, and we get a push down in core. Very much a work in progress, but I just wanted to give you guys an idea of what I'm looking at. So that's the first point. This, by the way, is anecdotal because it's not going to help us in our trading. It might help us in our investing, but it's not going to help us in our trading because of the lag. Okay. The blue line is the rate of change of M2. This is on trading. How do you plot it? It's very easy. You just go through to your indicators here, Sam. Just go through the indicators. Just click on that. I've got a lag here. Just click on that. What's going on here? My PC is not being particularly responsive. Okay, so you once you get the indicators up, Sam, just go rate of change. Bang. Okay, just click on that, change it to 12. The rate of change indicator is terrific. It's really a good indicator. If you want to know, how, let's just say, the stock market has performed over the last 12 months, just bring up the SPX, put on a 12-month rate of change. You've got your answer. It's really it's a nice easy. And then we want to just kind of keep an eye on this. Does that answer the question there? Okay, cool. Can we do that to see? Yeah, I'm gonna move to another. I want to keep up my M2 analysis here. I'm going to keep that. Let's go through to this trading view here. So just to kind of show you, I want to come back to this, but Anna's just asked to show the rate of change with the S&P. Let's have the S&P 500 has done over the last 12 months. So what you'll do is you'll make sure it's monthly, right? You can keep it it's weekly, but if it's weekly, you'll make your rate of change 52. If it's monthly, you'll just keep the rate of change 12. So we'll just keep it monthly. Just click in your indicator, which just is not responding. What is going on here? There we go. It's not responding to my mouse. All right, let's bring in the rate of change here. All right, now what you're going to do, Anna, is you're going to just double click on your rate of change. There we go. There's some sort of lag here. All right, you just put this on 12, click OK. And for the last 12 months, Anna, we're down 14% on the S&P. Okay, there's that. Yeah, that's your calculation. Somebody says to you, "How have we done? What's the percentage loss on the S&P?" Hey, it's 14.14%. Done. So it's a really nice indicator. All right. So that's the first thing I think we need to discuss. The second thing is to acknowledge just how much tougher our job has become over the last 24 hours. Become much harder to trade the market, in my opinion. And And the reason for that is because the Bank of Canada raised rates by 100 basis points. They did it a full percentage. Now, that is actually, again, astounding. And I'll tell you why it's astounding, because just a few weeks ago, we were only looking for 50. Then about a week ago, we were looking for 75. And all of a sudden, they've delivered 100. So going from 50 to 100 in the matter of a few weeks is huge. Now, what was their reasoning for that? Well, it's very clear in their statement. The Bank of Canada said more than half the components of our CPR are increasing by over 5% in terms of inflation. They're worried, and it's on a broad-based scale. So they front-loading they're front-loading with their hikes. Guess what that's done to their yield curve? Okay, let's go. Canadian 10 minus Canadian 2s, right? So we're looking at the 2s, 10s again. All right, inverted. Okay, just over the last week, boom, inverted, right? So they've pushed their yield curve into an inversion, just like the US. They've also set a precedent here, okay? It's kind of like go big or go home type of a thing. So now the market's pricing in 1% for the US on the 27th of this month. That's when we're going to get to the monetary policy. So we've got this now inversion on the Canadian. Incidentally, what happened with that announcement is that there was a huge push from zone 1 into the middle area. So this is the daily chart, US dollar Canadian. In other words, a movement down is the US the weakening against the Canadian. And that happened yesterday. There's this big push down into neutral. And then it looks like that is showing some strength again. We'll talk about that in a moment. But the point is, there was a definite response. Now, you take a look at the US 10 years to the US 2 years. Now, remember, we had this blowout inflation yesterday, right? Blowout inflation yesterday. Let's bring that. This is ridiculous. Okay, this is ridiculous. We minus 26 here, minus 0.26. Now, let's just go through to a daily. This is a fast steepening of the inversion. So go through to the daily. This is yesterday's movement. So we were at, take a look at it. We were at 8 basis points below zero. We're now at 26 basis points below zero. That's a massive steepening of the yield curve, except to the negative, right? It's inversion. So what is that telling us? First of all, it's, I think, preparing us for that 100 basis points come the 27th. It's also telling us that the US and now Canada are actually manufacturing recession, okay? They've now both pushed yield curves into inverted territory. And the point is, well, why are they doing that? Is because inflation is really a huge concern here. The fact of the matter is that the Canadian unemployment rate is at 4.9%. I took a look at it. It's the lowest in decades. The last time we saw a reading like that, I think, was in the early 70s. So they're counting on that so we're kind of counting, they're counting on that to provide a cushion for manufacturing a recession. Same with the US. The US on their U3, the U3, which is a very narrow reading, U6 is the broader market, but we've got 3.6% there, I think. They're counting on that to provide a cushion, right? So we've got this inversion. What does this inversion mean? It means that the likelihood of recession is now really becoming highly probable. It's not guaranteed, but it's highly probable. In fact, an argument could be made that we're in recession. which is probably true, the technical definition is 2 quarters of contraction. So we've got 1 quarter of contraction. I would argue we probably in recession, but the idea here is we're getting our inversion. Now, let's just take a look at a few of the other curves. So let's go to the UK, right? Let's see what's happening on the UK. So let's look at gilts. Let's see what's happening here. Okay, it's not quite inverted yet. Okay, not quite inverted yet, but it's flattening. I don't know it's flattening because it's heading towards 0. Flattening. Okay, so we want to just keep an eye on that. Let's take a look at German side. So let's take a look at Bund. All right, flattening quite heavily over the last 2 days. Flattening quite heavily over the last 2 days. We'll keep an eye on that. Let's just take a look at a few others. Sam asked me to take a look at GDP. Yeah, I think we certainly should do that, Sam. Let's just take a look at a few of the others. Let's take a look at Aussie. Okay, also flattening, not too, just over the last 2 days. So you can see the bond markets all flattening out over the last 2 days. We've got the Canadian and we've got the US inverted. We've got the UK, we've got Euro, we've got Oz, all flattening. Let's just take a look at one more. The Bank of New Zealand has been very, very aggressive. Let's take a look at theirs. Okay, also moving towards flat. Just wondering what's happened here. Nevertheless, moving towards 0. So we're all flattening. So the global picture here is, number one, the US screaming concern over recession, Canada moving into concern, and the rest of the world starting to flatten, starting to sweat a little bit. Okay, now what we'll do is we'll just bring up the GDP. I think this is the one we want. All right, so you can see here that the GDP on a year-on-year basis is also moving towards 0 here. Okay, so the GDP in the US slowing down markedly. Okay, so you can see China. Yeah, we can take a look at China. China's a bit odd. I think it's CN. It's odd because it's a there's capital control. Same with Japan. There's capital control. So is not to get the, I think the market opinion is perhaps a little cloudy. All right, so China kind of holding up. China holding up, but I'm not sure how much. I'm not sure what kind of information getting, because the People's Bank of China, you know, they very much monitor these levels. Same with the Japanese yield curve, not going to give us any information. They're defending that 25 on the 10 years. I think at some stage that's going to, you know, they'll drop that, and then I think there's going to be a huge movement in yen. I think the yen strengthens remarkably, but it's just an opinion. All right. Let's take a look at one more yield curve, and then we're going to do some chart analysis. The next yield curve, I think, is very important. Slightly different to what we've looked at previously. It's the 10 years against the 3-month. So let's just bring this up. So we'll first do the 10 to the 3 month, then we'll do the 5s to the 3 month. And I'll tell you why I think we have to watch this as well. You can see, let's just go through to weekly. So this is again, we're looking at a weekly. Now, when I looked at this on the weekend, we were over 1% on this yield curve. We're now at half of that in less than a week. Like, what? Can you see that? It's like, okay, let's just take a look at the 5s to the 3. And then the whole point is, well, what does it mean? Okay. Okay, the 5s to 3 also not quite as bad to the 10s to the 3s. So 10-year to 3 month, 5-year to 3 month. This is actually what the banks are going to be focusing on. This is bank margins. This is bank profit, right here. Okay. So think about the operating, the business model of a bank. They'll borrow at on the short-term side of the curve. So you just think about it in terms of retail banking. You put your money into a savings account and they'll pay you sort of a very short-term interest rate, okay, and then just amp that up, aggregate that up by all their clients. They might go through to other banks and do overnight repos. They're called repos, okay, and they'll sort of borrow and lend on the repo market, and that's overnight. Very short-term, right? They look at the short-term as their cost side. Okay, the short term is their cost, and then they want to loan out on the longer term side. They want to give out. So think about mortgages. That's longer, or maybe just so what they want to do is they want how's a bank going to make its profit? Okay, how's a bank going to make a profit? They need a steep curve. And they need a steep curve. Let's take this out. This is from yesterday, I think. Right? They need a steep curve. If you're running a bank, okay, this is where you borrow. This is where you lend. Okay. This here is your profit margin. That's your profit margin. Okay. Now, what's happening here? We're flattening. But we're not just flattening. In less than a week, we are flattening. It's a huge movement. Okay. So now we don't have a steep curve anymore. We kind of got something like this. All right. Got something like this. Now you're a bank, and what is a bank? If anything, it's a profit maximizing gargantuan behemoth, right? Now, it's all about profits for a bank. Let's be honest. Okay, they are profit maximizing institutions of note. Not only that, they're the linchpin. They're basically the middleman between central bank policy and the real economy, right? Now, all of a sudden, your profit spread has narrowed to a point that's probably not worth it. What do I mean it's not worth it? There we go. So, and saying, but they're going to be reluctant to lend. Well, that's the point. Okay, think about it. Everything is risk to reward. Everything. So, and we discussed that yesterday, right? So, you want to lend money out. Sure, you'll lend money out. Okay, you've got to maximize your profits. But now you've got such little spread to play with. Well, your risk checks start increasing remarkably, don't they? You're going to be reluctant to lend out money except to the best candidates, which I could understand because that's risk to reward. But it's sort of it gums up the system a little bit. Okay, so So the whole idea here is the profit motive for banks is starting to erode quite drastically. And we got the bank earnings this week. Now, if we go back to, so Rob's, so time to look at retail banks to short. Well, this is going to be interesting, Rob. The idea here is what I'm interested in is number one, okay, profits. Let's say profits are okay for this quarter because we were actually steepening until May. So then May, June it comes down, but sort of maybe the first part of the quarter not too bad. All right, and then of course it comes down. I think where it gets interesting, Rob, is exactly what you're saying. Well, what's their forward guidance going to tell us? Are they going to say, well, our credit conditions have tightened up remarkably? That's a distinct possibility. So, number one, I think profits are going to be affected. Number two, what's it? This is the linchpin of monetary policy. Okay, so how does it affect the monetary policy and central bank aims in terms of monetary policy? I've got to think about that. But this is kind of the middleman. So the whole idea here, Rob, I think you're onto something. Is of course the forward guidance of the banks. The forward guidance of the banks, I think, set the tone very much. It's going to set the tone very much, and I think that's why there is possibly more pain to come in the stock market. And here's the $1 million question: is it time for QE to restart? I certainly don't have an answer. I don't think anyone has an answer. I think first of all, we probably in the midst of QT. So I think quantitative tightening continues. Until what level, I don't know, because we have used unconventional monetary policy here. Okay, remember this weird spark in M2, unconventional monetary. Now we've got all sorts of problems. What's our problems? We've got no profit margin for the middleman in terms of the economy. Astounding. And now we're going to have QT, and we've got a manufactured inversion in two of the industrial economies, and it looks like the others are heading towards major flattening. Guess what's going to happen to their banks' yield curves, right? Same thing. So we're kind of having this big question mark. By the way, I don't have an answer for it. I don't think anybody does. But you can kind of see how the economy is starting to gum up, right? So is it time to QE to restart? I mean, Anna's saying, well, everyone's talking about a pivot, and then Rob, you're saying is it time for QE to start? That's the same side of that coin, okay? That's the same side of that coin. In other words, is the tightening over? The tightening's not over. We're getting 100 basis points in 2 weeks, right? I can tell you that that's going to happen, right? If it doesn't happen, I would be so surprised. I would kind of put my hand over my mouth and I'm so sorry, guys. Like, that's unbelievable. So the pivot's not going to happen in 2 weeks. We've got to start looking at September. And the point is, we have mentioned this previously. Has the Fed got that much room to maneuver? Highly doubtful, but the point is they're kind of going full steam ahead at the moment, stepping on the accelerator, and they're fighting inflation. They're fighting inflation left, right, and center, to the detriment of economic activity. Is there going to be a pivot? I don't know. Good question. Is it time for QE to start? I don't know that, but I think that's going to cause more problems down the road. But in the same breath, Rob, I'll say the QT is going to cause problems down the road because it's such unconventional policy. Come back to this diagram that we started this whole webinar off with. What happens if we're making a policy mistake right now? What am I saying? So I'll just put through sort of food for thought. Again, I don't have the answer. But if there's a lag between the rate of change in M2 and inflation, well, then the adjustment's already been made. The pivot's already been made, okay, over here. The pivot was made back in January 2021, okay, in the rate of change. The pivot was made in the rate. It's just there might be a lag there. Now, this is a huge supposition. Let's not kill it. It's a huge supposition. But assuming that the pivot's already been made, imagine the policy mistake that's going on. Tough position for policymakers. Tough position. Now, in light of all that, let's take a look at some charts. All right. Take a look at some of the charts here. So we've just gone through to the baseline just to get. So what happened yesterday is yesterday's price action was so confusing. I've got an idea of what I think happened, but I'm not sure if this is correct, right? So this over here, if we go back to this, this is a 4-hour candle. This is a CPR coming out. It's a 4-hour candle. At the same time, if you take a look at euro, and this is the CPR coming out over there. Even Bitcoin CPR coming out there. Over here, go to the loonie now. CPR coming out. Now, what happens? What happens just after that? The Bank of Canada makes a huge surprise announcement. Hey, look, then everything adjusts. Loonie adjusts, dollar adjusts, euro adjusts, cable adjusts. Everything feeds off of the European, everything feeds off of the Canadian 100 basis point pivot. I think that's the catalyst for what happened. And I think that the market was thinking, well, hang on a second. Bank of Canada now probably setting the tone for the rest of the industrial central banks. Again, I'll come back to, I don't think they have enough steam to really compete with the Fed. So these kind of pullbacks on the dollar, I think all of a sudden become interesting. The pullbacks on the euro become interesting. Pullbacks on pound become interesting. Pullbacks on loonie become interesting. Pullbacks on gold become interesting. Because we've got in, why did I start off and say, well, we're in a much tougher environment? It's because now all central banks are going full steam ahead, it seems. I think the Bank of Canada has changed the environment quite a bit, subject to correction, but a 50 basis point pivot to 100, that's massive. Yesterday, when the CPR came out, we were looking at 40% for a 40% for 100 basis points. When I logged in this morning, it's now 77.4%. Less than 24 hours later, that's a huge pivot. So there's a lot happening in the market. Again, markets are now. We'll kind of end off here. Markets are perfectly efficient, in my opinion. This is a debatable point, right? Okay, so we'll talk about, so let's just talk about this, and then we will talk about Bank of Japan. Okay, so the idea here is markets are efficient. Where's the inefficiency? It's in the information. And I think there is a lot of information overload at the moment, and we're trying to figure out what the heck's going on here, you know. And that's why you're getting these weird kind of big blue candle up, big red candle down, and now we reversed again. Now, what happened, Anna? Gold dropped first. Gold dropped first. Yeah, it dropped first. You see that? Gold dropped first. Once the CPR, gold was down. Then comes the 100-point announcement. Bang, shoots up. Guess what's happening? Now it's putting back down. What's it? I think we're trying to sort of synthesize this information? Very difficult. Very difficult. I think the last point, Rob has brought up Bank of Japan. This to me is it's contentious. So what's happening with the Bank of Japan? So you have something called JGBs. Okay, JGBs are the Japanese government bonds. You could just go JP10Y here. The data here I don't think is that clean on TradingView. Again, I'm not sure, subject to correction. I don't think that the data is that clean. You can go through to the Ministry of Finance here, but it looks like it's out of date. Okay, if we go here, we're only getting data to the 25th of April, so the data feed here is not working. Okay, so then you go through to JP10Y, and we can go through to TradingView. Okay, so yes, TradingViews, and we'll bring that up, and you can see that we've got these weird sparks here. So I think these weird sparks are coming off the futures market. I don't think this is coming off. So I think there's like weird data spikes in futures that's feeding into here. What's effectively the Bank of Japan doing? Okay, yeah, it shot up at the Canadian. Exactly, it shot up at the Canadian. Why didn't it shoot up at the Canadian? The market reacted against dollar when the Bank of Canada surprised to the upside. When the bank, in other words, perhaps I think so. What I think. Pressure from hedge funds, yeah, definitely some sort of assimilation of the data, probably from hedge funds, but the hedge funds now are, if they're on the wrong side, because it was just sort of a 1 4-hour candle and we've reverted out. In other words, the Bank of Canada 100 basis points took all the emphasis off of the Fed. Okay. And then, so we saw bounces in, we saw a huge pullback in US dollar. Well, once US dollar starts pulling back, loonie benefits, euro benefits, cable benefits, gold benefited. But it's kind of, so that's what I'm saying, is that assimilation of data. Now that synthesis, am I saying it right? Synthesis, let's call it assimilation of data. So yeah, it spiked because the US dollar pulled back because the 100 basis points took all the focus for about 4 hours off of the Fed, and then it's resumed back on the Fed because we're getting 100 basis points in 2 weeks, right? So I would expect gold to come under pressure, okay? Because that's what we are discounting right now. What's the point there? And the point is, the markets are efficient, the information that's inefficient. And I don't know, when that efficiency returns. So much is happening over a 24-hour period. Very difficult to synthesize, right? That's the word I want to synthesize, right? So let me know if that sort of helps. You go through to the Bank of Japan, and the Bank of Japan here is defending this 25 basis points level. That's lunacy. It's ludicrous. Okay, it's absolute lunacy. It's currency manipulation. That's effectively what it is. But nobody's calling them out on it. But that's what it is. Okay, so let's just add the US dollar Japanese yen here. So there we go. So it's a bit lag on my trading view. Let's just bring it up. US dollar, Japanese yen. Okay. Let's bring it up. And just take a look what's happening. It's the yen is capitulating against the US dollar. Why is it capitulating against the dollar? Well, go through to the US 10-year minus the JGBs, okay? And let's take a look at the spread. Okay, it's just there's just a huge spread in favor of US 10 years. If you've got any money in Japan, you're not earning any yield in Japan. You'll take your money offshore and you'll seek it elsewhere where there's a higher yield. How do you do that? Well, you've got to buy the foreign currency, sell Japanese yen. That's currency manipulation. And that's exactly what's happening. Now, the whole question here, Japan's got a stagnant growth and big demographic problem. They've actually got inflation. Japan actually has inflation. Now, the Bank of Japan, any central bank, their mandate's to deal with inflation. Their primary mandate's to deal with inflation. So the Bank of Japan's got that mandate. They've got to promote price stability. They have to do it. That's the sole reason. That's the sole reason that they exist, theoretically. Any central bank. Okay, there's no other reason for a central bank to exist. In the US, they have two mandates: full employment, price stability. But every other central bank, except maybe a few, have price stability. Same with the Bank of Japan. They're causing price instability. That's what they're doing. By defending the 25, they're causing price instability. How so? They're importing inflation. They have to be importing inflation because their currency has devalued heavily against the US dollar. Just think about oil. Japan doesn't produce oil. They import their oil. They're importing inflation. Okay? That's price instability. At some stage, they're going to have to relax. At some stage, they're going to have to relax this defense. At some stage, they're going to have to relax this defense. Okay? If inflation continues to be a problem, they're going to have to relax this defense. That's a massive event right there. Massive event. The longer that they defend this 25 basis points, the more potential energy is building up against Japanese yen weakening. Okay? The longer they do it, the bigger the event. Okay? The longer they do it, the bigger the event. Now, they can alter their defense. They can say, well, instead of us defending 25, we're going to defend 50. That might be something that they choose to do. And if they do that, there will still be a currency event, but it'll probably be a lot more controlled. But you don't have to go far. Go back to January 2015. Go back to January 2015. Okay, Euro Swissy. Okay, go back to January 2015. You guys see this? See that? That was hugely damaging to hugely damaging. So much damage was caused by this spark here. Who was it caused by? Swiss National Bank. Swiss National Bank caused that. Why? They were defending the 120. So every time, okay, Euro Swissy hit 120, every time from this period, so for like a 3-year period, every time it hit, they defended it. Okay? They just sold euro, bought Swiss franc, and defended it. Okay? So there's a huge buildup of potential energy here. Because fundamentally, euro should have dropped below 120. Euro Swissy should have gone below 120, fundamentally. But there was a huge central bank interference here. And then comes January 2015, without any warning, they dropped that defense. Just dropped that defense. Boom. It wasn't a peg. They're not pegging. So a peg is like kind of you peg your currency to the dollar. That means you would make sure that your currency sort of follows the dollar up or down. Okay. That's a currency. This is which is also a form of interference, right? So you drop the peg, you're gonna have interference. Well, okay. Now that's Euro Swissy. That flowed over into US dollar Swissy. Okay. Okay, here it is. You can see that the US dollar reacted, sort of sparked down, sparked back up. So there was a spark, not quite as heavily sparked down, because the defense wasn't against the US dollar, it was a defense against the euro. So that's why the euro was so much harder hit. Okay, now when we're talking about JGBs, okay, we're probably talking about either the second biggest or the third biggest bond market. I'm not sure if China's bond market is bigger. I have a feeling that Japan's bond market may be bigger than China's, but that is a feeling, subject to correction. But the point is, we're in the top three, and you have a potential here for a huge event, because at some stage, you can't fight the inflation. Okay, yeah, basically what the Bank of Japan is hoping is that the Fed does all the fighting for it. Okay, so the longer this builds up, it hasn't been so long now, but let's just say this builds up over years. Again, that's supposition. Imagine what happens when they stop defending this level. It's scary. All right. I think that's where we'll leave it. We've gone over an hour here, so well, I logged in like just under an hour. All right, guys. Any questions before we log off? All right. I think we'll wrap up here then, and then we'll chat tomorrow, guys. Chris just asking about Euro, US dollar, and parity. Very good question. So let's just bring that up. There's no US session, Ursulan. At the moment, we just do the one session. Just do the one session. So the US session, we're doing more of a focus on written content. So we've dropped the webinars just to the morning, and then we'll do an extra one on Wednesday for cryptos. If we go through to Euro US dollar here. Well, the obvious question is what's going to happen with regards to parity. And I would tell you if I've got some sort of, don't know, we'll just go here. So I think we're going to break parity, Chris. Why do I think that? For exactly everything we've spoken about today, the discounting from 75 basis points to 100 basis points. I think that the Fed monetary policy versus the ECB monetary policy is highly influential. And then 2 days ago, or no, yesterday we looked at the global trade, and it brought up very, very important in retrospect, right? So I think if those trajectories, as long as those trajectories maintain, Chris, I would expect sort of rallies. I would expect any rallies to kind of be targeted by shorts, because it does seem that parity will be broken at some stage. Does that help? All right, let's wrap up here. I'll put this on Telegram. Thanks, guys. Speak to you tomorrow.